Welcome to the Asset Coach and Tax Strategist YouTube channel. If you're a subscriber, thanks so much for subscribing. If you're a first-time viewer, thank you for spending your time here with us. If you like our content, please give us a thumbs up. For you new folks, Asset Coach Tax Strategist YouTube channel is based on the book Economic Termites. This is a book that I wrote a few years ago talking about taxes, inflation, time, laws and regulations. Also, I wrote a second book called Farming Assets. Those two books is really what this whole channel is about, addressing those situations and how they affect you and I in our ability to grow our wealth. So as an asset coach and tax strategist, my name is Robert Wolf. I am the CEO and founder of Terra Firma Business and Financial Consultants and its affiliates. We have a bunch of companies that we've built out this ecosystem surrounding the basis of what we talk about on this YouTube channel. So if you're not a subscriber, hit that subscribe button. We drop episodes every Thursday. Again, if you are, thanks so much. And let's get into this next episode. Welcome back to another episode of Asset Coach and Tax Strategist. Today's episode is really going to kind of piggyback off another gentleman that I like to watch. His name's Toby Mathis. He's a tax state attorney. I like his content, and there's a lot of things that he talks about. There's quite a few attorneys and CPAs and that I follow, and business strategists on YouTube to help kind of reinforce a lot of the information that I've studied and I've learned and experienced in my 2 decades of helping business owners and medical professionals really focus on structuring and strategizing their businesses. So there's a purpose and a reason why I call my name or my title Asset Coach and Tax Strategist, because really when we look at this, taxes are a symptom or a byproduct of a root cause, and those are our assets. So an asset, based on Robert Kiyosaki's definition, is something that can grow and create money, income. So makes sense. So that income, though, determining on the asset, the IRS, the legal system, the IRS tax code has certain guidelines and focuses on taxes on that particular asset. So how it generates income determines how it is taxed. Okay, so we need to understand that. So if we want to lower our taxes, we need to understand the legal system of our assets and the rules of those assets. So that's why I wrote my book, Economic Termites and Farming Assets. And when we go through this process working with our clients, we talk about something called the 3Ds, what we consider the most tax efficient assets, and not necessarily our opinion what the most tax efficient assets are, but when we look at certain assets, how many tax benefits does the IRS give it? If the IRS gives it a lot of tax benefits, then we can only conclude that is one of the most tax efficient assets. And so maybe we should do it, use it, right? If we want to lower our taxes. Okay. Now, here's the interesting thing. In going through this process of understanding this as a legal system, not trying to find loopholes, not trying to find certain mistakes, that sort of stuff, the key is you need to be a business strategist. Why? Because the tax code is written for business owners. And so if you're strategizing from a business perspective, that is going to cause you to enroll in the tax savings that the IRS has. Okay, the IRS is our business partner. They give us the tax code so you and I as business owners can have less tax liability, have more cash flow. So we take our more cash flow and put it back into the system, whether it's in our business to grow our business to where we can't do everything on our own anymore. And so we have to hire employees, W-2. That is the tax revenue the government wants. Okay, that's when they communicate unemployment, payroll taxes. That's what they're talking about is, hey, just to let you all know, here's what our revenue stream looks like. Okay, now the other thing is independent contractors are just as valuable as employees because they're separate independent business owners as well. And the tax code's written for them also. Know what the tax code is not written for? W-2 employees. That's the highest tax rate. So if you want to lower your taxes or your tax liability, You need to focus on how to utilize the legal system based on how the IRS lays it out for you. So the reason why I brought this up is that when we talk about our 3Ds and how do we use these 3Ds is what we call the asset buddy system. Toby does a great job of breaking this down, and I say breaking it down not to less than 3Ds, but adding additional Ds. He calls them the 8Ds. And he expands it beyond what I expand at, or what I focus on the 3Ds. Now the 3Ds are part of this. Okay? Now, I'm going to go through his. And what I find, and I'm not going to go into the detail that he does because, this is kind of his process. I want to give it from my perspective and and there's going to be a lot of similarities, right? Because the tax code is the tax code. When you're focusing on strategizing, like any game, think about this. Any game, you know the rules to the game. Once you know the rules, you get to strategize. You can look at American football. You can look at chess. You can look at checkers. You can look at Scrabble. Any game, you know the rules. Once you know the rules, you're able to strategize what it makes sense for you and what you want to accomplish. Our business partner, the IRS, just asks us to communicate to them on how we're doing that. Okay. And you've heard of the book called Love Languages. So the IRS's love language is accounting, is numbers, is documentation to prove why we're doing what we're doing. Okay. That's it. And like any relationship that thrives, it's based on communication. So think about how most people, maybe yourself included, I fell into this category as well before I actually started learning. How do we speak to the IRS? And is that a language that allows that relationship to thrive? And the answer is no. So when we look at and we shift our mindset, we shift our focus on, hey, the IRS could be taxing our top line revenue. They could. States do. So they don't. What they do is they say, go into business, try to make money, and whatever's left over, or however you distribute the cash, we can use that as income that we will tax, meaning we, the IRS. Okay, so let's go through these 8Ds and kind of look at this. So the first one is divide. What do we mean by divide? Well, really, it's focusing on the legality of every business. Every business has a purpose, has a risk or a liability to that. Okay. So when we talk about investing, all investing has risk, even in cash, right? We have inflationary risk and all that fun stuff. So when we look at risk and we look at a business or we look at an asset, it makes sense to divide each of those into separate liability structures. It could be an LLC or whatever, trust or whatever makes the most sense in that particular situation. So first D, divide. Second D, deduct. Deduct. Well, that's one of our 3Ds, deduct. What is business? Setting up an entity allows you to have expenses. There's a cost to running a business. Those are expenses. Those expenses are subtracted off of revenue that's generated out of that business. Okay, because you're trying to make money. Okay, so spend as a business. Don't try to fake it. There's no necessity to that. I get it all the time. Can I write off my car? Can I write off my meals? Can I write? Yeah, if it's for business. If it's for business. But if you're a hospital employee, if you're a doctor that is at the hospital and you don't go from hospital to hospital, clinic to clinic, urgent care to urgent care, surgery center to surgery center, then no, you go to one location and no, you can't do that. You're going to need to set up another business, some other side hustle that allows you to structure that separate entity, utilize that vehicle purposely for that particular entity. But that's very important. So you spend as a business, that allows you to deduct. Okay. Number 3 is dump. Right? Like, what do we mean? Asset harvesting. What do I mean by that? In the AUM, in the investment world, their advisors will look at your winners, the investments that are winning, and the investments that are losing. And what they'll do is they'll talk about tax harvesting. What that means is sell the winners. Now, if you sell them and you're going to have a capital gain, but if you sell losers, you're going to have capital losses, and they offset each other. So short-term, long-term losses offset each other. Okay. And so there is the ability to tax harvest. But when we're talking about dumping, we're talking about all assets. How do I utilize my real estate, my brokerage account, my cash value life insurance, my business? How do we use all these different assets at different times? That goes back to the divide, goes back to the deduct, right? So number 4 is depreciation. Now this is our second D. Depreciation it's an expense. It's an expense the IRS actually gives us. Our business partner gives it to us, saying that, yeah, there's physical property that depreciates, that devalues over a period of time. And with the one big beautiful bill, there's the ability to accelerate that depreciation in a shorter period of time. Most physical assets have physical property that's used as an asset. So what's an asset? Something that's there to generate money and income. Okay. So if you have a piece of equipment or you have some kind of physical structure property that's used for business, it has a depreciation schedule that the IRS has provided it. You can accelerate that to take a larger expense because it's a depreciation expense. Okay. So this is why everyone loves to go into real estate. But keep in mind, once you accelerate that expense, then whatever cash flow that asset creates after that, you won't have the depreciation expense to offset that income. So you will actually be making more income or more cash flow, which could be taxed as income. So what do people do? They go back and buy more real estate, and you see this rinse and repeat. There will be a time where you have so much real estate that is cash flowing, and I'm just using real estate as an example. You'll have so much real estate cash flowing that it will outpace the depreciation of those new properties. So it's like playing Monopoly, right? Little green houses to a big red hotel. So that's why you upgrade, right? Because you get larger depreciations and so on and so forth. Okay, in theory. But if you're a doctor, you're a business owner, what's your business? Doctoring in business, right? So all of a sudden, real estate becomes another business. It's no longer a side hustle. Now it becomes like a full-time business because of the amount of work that it takes. So it doesn't mean it's bad. It's just mean, how do we utilize depreciation expense to help? Okay, and I just use real estate as an example because it's a common thing. Number 5, delay. Waiting to be taxed. What's that mean? Deferring. So 401ks, the retirement accounts, also real estate or your business. When do you sell real estate? So yes, your business creates cash flow and it can create income that becomes taxable. But if you grow your business, it's an investment, it's an asset, you grow it, you started it it cost you $100,000, your cost basis, it cost you $100,000 to get it up, and 10 years later, it's worth 10 million. You sell it for 10 million, well, that's capital gains. That's capital gains. So what he's talking about delay is, how do we structure our asset deals to where we're delaying the taxation? You cannot outrun the IRS. You can delay or defer to different parts of the legal system to where at some point, or you can use other tools, assets, to be able to pay for it. So one of the things we like to use to pay for taxes is life insurance. It's the most cost-effective way to pay a premium. And once you pass away, there's a larger death benefit, a reward off of that premium, that reason why you're paying that premium to pay taxes. But that's estate planning. It's a separate part of the legal system. It's not taxation. It's not your business. This is estate. It's a separate part of the legal system that, yes, deals with taxes, but it deals with how to delay those other taxes, right? We always want to work with our business partner, the IRS, but our business partner, the IRS, has laid out this foundation for us. Okay? We just need to follow it. It really, you don't need to look for loopholes. Just follow the rules. It's very simple. So delay was the number five. Number six, donate. Yeah, give back. Give back to the community. Oh, Bobby, but I work hard and I made choices and this person, these people don't make choices that and I sacrifice. Yeah. Yeah, I get it. You're blessed. So are they. They're blessed in different ways. We're all blessed. We're all human. We're all connected. We're all in this rock together, right? And so some people make choices, bad choices that affect them more than your bad choices have affected you. You're not immune to bad choices. Okay? It's just your bad choices didn't create the bad luck, or you didn't have a string of bad choices and decisions that some other people have. Maybe because they came from a really good family and they feel guilty about it, or they came from a horrible family and they suffered from it. But on the opposite side of the coin, I can say the same thing. There's lots of people who thrived in good families, and there's a lot of people who thrived in bad families. The excuses are the person in the mirror. It's our own choices. Now, are we going to accept, are we going to humble ourselves, or are we going to put ourselves in a position to where we can change our choices? Which also means that not to blame other people for their choices, but being able to donate and help back to your community helps those people. And in that, our business partner, the IRS, gives us tax benefits for that. Now, there's certain ways to donate more effectively and efficiently than just throwing cash into a can. Okay. And so donate, number six, is another very, very viable option. There's a whole separate area of structuring and how we do this. And the bigger the benefit from donation, it really, when you think about a lot of the things with the IRS tax code, is you give up control of an asset. It's no longer your asset, and you get benefits from that as well. So in certain types of donations and structuring of that, sometimes it can mean giving up certain assets, but you get a huge tax benefit from that as well. So every situation's different. So really looking at how do I utilize that in my overall plan. Number seven is disguise. What's that mean? Well, disguising really means again, it kind of goes back to number one, divide, in looking at certain entity structuring and utilizing entity structuring of how do I shift, how do I structure certain things with the ability to show what I'm doing, but also kind of show what I'm not doing, if that makes sense. There is some ability to cloak what you're doing in entity shifting. But again, what's the point of an entity is to try to make money. So but there's also a liability, a separation of personal and business liability, right? So utilizing these entity structures, whatever they are, whatever your situation is very beneficial. And this is really where attorneys come in place, especially tax attorneys, where they can look at the tax code. And most tax attorneys that I've worked with also are business attorneys. Why? Because to be a tax attorney, to know how to lower taxes, you need to be a business strategist. Why? Because the tax code's written for business owners, right? See the connection, see the link. So estate attorneys is a different form of law. It's a different form of the legal system. It does incorporate tax and does incorporate business entity structuring, but estate has a different focus, has that delay, that defer focus. Number eight is disinherit. This goes now to the estate planning side of things. How do we structure our assets? How do we structure our estate to where it is able to shift to future generations? But also, how do I incorporate the other 7Ds in this disinherit structure, depending on where your wealth and your estate level is at? Okay. Now, again, like I said, everybody is in a different situation. It doesn't mean that right now, if you're not in that situation, you can't get there. If you're there, you should probably make some really strategic decisions to start looking at that. Yes, it's going to be costly, But it'll be even more costly to all your hard work if you don't. Why? Because you're going to have taxes. Taxes are going to be the biggest liability. Again, the IRS, if you do not plan, if you do not work with your business partner, the IRS, eventually they will benefit from this relationship if you do not try to utilize the gifts, the rules that they've laid out. Okay? You don't get penalized for using the rules. You do get penalized. Certain people get penalized for manipulating the rules, for you being being a little deceptive in the rules. And so if you're a little cagey, you should probably not be cagey. You should probably be very, very open and descriptive of what you're doing and why you're doing it, the motivation, the story, the behind the scenes of why you're doing something. Okay, that's really the case. And one of the things we always talk about is because we have a lot of our people come to us and say, well, I need to lower my tax liability. Should I go buy equipment? And our response is always, well, do you need the equipment? If you don't need the equipment, why would you give away 60% plus of your money to get a 30% benefit? Even if you're in a 50% tax bracket, why would you give away half of your money to save half of your money? Right? So it would make more sense to look at the 8Ds and be a little more strategic in what you're trying to do. And by doing that, that will lower your taxes. But going out and just buying equipment, that's not going to do it. Just going out and spending money is not going to do it. Now, distributing your cash flow in certain strategies that are structured using these 8Ds can lead to lower tax liability. But that's what I'm talking about, is understanding the rules, and then you're able to reduce your tax liability legally, not hunting for loopholes, just using the system that's there. So, hey, if you like this content, please feel free to give me a thumbs up. I appreciate your time, appreciate you being here. If you have any questions, throw those in the comment section. But other than that, I appreciate you being here. Go make it a great day.